Why does a mutual fund's NAV change every day? What exactly is NAV? And how do expenses reduce investor returns? Chapter 7 answers all these questions. This is a highly scoring and numerical chapter in the NISM exam. At the end of every business day, a mutual fund must calculate its net asset value, or NAV. This single number represents the fund's per unit market value. But how can we trust this number to be accurate? The answer lies in a core principle mandated by the Securities and Exchange Board of India, SEBI. This principle is fair valuation. It's the bedrock of transparency and trust in the mutual fund industry, ensuring that every investor is treated equitably. Without it, the entire system of daily NAV calculation would be compromised. Mutual funds must value their investments fairly and transparently, not just as a best practice, but as a strict regulatory requirement. So, what exactly is fair valuation? In simple terms, fair valuation is the process of determining the price at which an asset could be bought or sold in a current, arm's-length transaction between willing parties. It's about finding the most accurate and realistic price for each security in the fund's portfolio at a specific point in time. The goal is to ensure that the value of the assets reflects their true current worth. This is critical because it prevents any single investor or group of investors from being unfairly benefited at the expense of others. For instance, if an asset is undervalued, new investors could buy into the fund too cheaply, diluting the value for existing unit holders. Conversely, if an asset is overvalued, exiting investors would receive an unfair windfall, harming those who remain. Fair valuation closes these loopholes. To enforce this, SEBI has laid down clear guidelines. First, funds must primarily use market prices from independent sources. For listed stocks, this is the closing price on the stock exchange. For frequently traded bonds, it's the weighted average price from the reporting platform. Second, every fund house must have a detailed board-approved valuation policy. This document outlines the exact procedures for valuing different types of securities, including the hierarchy of sources to be used. And third, this policy must be applied consistently day after day. This consistency is key to ensuring that the valuation process is not just fair, but also predictable and auditable. But what happens when a market price isn't available? This is common for certain types of debt securities, like lower-rated or long-tenure bonds that don't trade every day. In such cases, SEBI's guidelines permit the use of valuation models. Asset management companies, or AMCs, must use prices provided by independent SEBI-registered valuation agencies. These agencies use sophisticated models, often called a valuation matrix, which consider factors like the issuer's credit rating, the security's tenure, comparable trades, and prevailing interest rate trends to arrive at a fair price. This ensures that even illiquid securities are marked to a realistic value, rather than being carried at an outdated or arbitrary price. And here's a crucial exam tip. The ultimate purpose of fair valuation is investor protection. It safeguards the interests of all unit holders, whether they are entering the fund, exiting it, or remaining invested. By ensuring the NAV is a true reflection of the portfolio's value, fair valuation creates a level playing field, which is the foundation of a healthy and trustworthy mutual fund ecosystem. Now, let's unravel one of the most fundamental concepts in the world of mutual funds: the net asset value, or NAV. What exactly is it, and why is it so crucial for every investor to understand? Think of the NAV as the price tag on a single unit of a mutual fund. Just like a share of a company has a stock price, a unit of a mutual fund has a NAV. It represents the market value of all the assets held by the fund, minus its liabilities, on a per-unit basis. This value is the price at which you buy or sell units of the fund. The core formula for calculating the fund's total net assets is straightforward. It's the total market value of all assets minus the total liabilities. This gives us the net worth of the entire mutual fund scheme, but as an investor, you don't own the entire fund. You own a certain number of units. Therefore, the NAV is always expressed on a per-unit basis. This ensures fairness, as it provides a standard value for each and every unit of the fund. So, the complete formula we use is the NAV per unit equals the fund's total assets minus its total liabilities, all divided by the total number of units outstanding. Let's break down each component of this crucial calculation. First, what constitutes the assets? This includes the current market value of all the securities the fund holds, such as shares and bonds. It also includes cash and cash equivalents held by the scheme, plus any receivables. Receivables are assets that are owed to the fund but haven't been received yet, like dividends declared by a company or interest accrued on a bond. On the other side of the equation are the liabilities. These are the fund's obligations. The most significant liability is accrued expenses, which includes the fund management fee, custodian fees, marketing expenses, and other administrative charges that are calculated daily. Let's walk through a practical example to see this in action. Imagine a mutual fund scheme has total assets valued at Rs 100 crore. Its total liabilities, including all accrued fees for the day, amount to Rs 2 crore. The scheme has issued a total of 10 crore units to all its investors. To find the NAV, we first calculate the net assets, Rs 100 crore minus Rs 2 crore, which equals Rs 98 crore. Then, we divide this by the 10 crore units outstanding. This gives us a NAV of Rs 9.80 per unit. This is the price an investor would pay to buy 1 unit or receive for selling 1 unit on that day, before any applicable loads. It's vital to remember that the market value of assets fluctuates daily, and expenses are accrued daily. Because of this, the NAV must be calculated at the end of every business day. Here's a key exam tip. For all open-ended schemes, SEBI mandates that the NAV must be calculated and declared daily. This ensures that all transactions, be it purchases, redemptions, or switches, happen at a fair and up-to-date price, reflecting the most current value of the underlying portfolio. Mutual funds can distribute income under IDCW option. Distributable surplus includes realized gains, income earned, excess reserves. Important points: dividends are not guaranteed. NAV falls after dividend payout. SEBI regulates dividend declaration. Dividends reduce NAV but not investor wealth. Now let's discuss 2 important concepts you'll encounter: entry loads and exit loads. These are fees that an asset management company, or AMC, might charge investors. Understanding them is crucial for calculating your actual returns. First, let's talk about entry load. The rule here is simple. It is not allowed. In a significant move to protect investor interests, the Securities and Exchange Board of India, or SEBI, banned entry loads completely back in August 2009. Previously, this was a percentage-based fee deducted from your initial investment amount. For example, if you invested 10,000 rupees with a 2% entry load, only 9,800 rupees would actually be used to buy mutual fund units. The ban ensures that 100% of your money is put to work for you from day one, making the investment process more transparent and cost-effective. On the other hand, we have the exit load. Unlike an entry load, this is a fee that is still permitted and widely used. An exit load is charged when an investor redeems or exits their investment before a specified period has passed. Its primary purpose is to discourage short-term trading and encourage long-term investment discipline, which aligns with the fundamental principles of wealth creation through mutual funds. This fee helps maintain stability within the fund by reducing the impact of frequent large-scale redemptions. Let's see how it works with an example. Suppose the net asset value, or NAV, of a fund unit is 10 rupees. The fund has a 1% exit load if you redeem within 1 year. If you decide to sell your units within that first year, the exit load will be applied. The calculation is 1% of the 10 rupee NAV, which is 10 pays. This amount is deducted from the NAV, so your redemption value per unit becomes 9 rupees and 90 pays. And here's a key exam tip. The exit load is always adjusted against the NAV. It is not a separate charge, but is factored into the final redemption price you receive. The amount collected as an exit load is then credited back to the scheme itself, which benefits the remaining long-term investors in the fund. Mutual funds must follow SEBI accounting norms, standard disclosure formats, and periodic reporting. Includes daily NAV disclosure, monthly portfolio disclosure, and annual financial statements. The purpose is transparency and investor confidence. A segregated portfolio is created when a credit event occurs, or when an asset becomes illiquid or is downgraded. There will be a separate NAV for the main and the segregated portfolio. No fresh investments are allowed. This protects existing investors. What is TER? TER, short total annual expenses. Average AUM includes fund management fees, marketing and distribution expenses, administrative costs. Impact of TR, higher TR, lower returns, lower TR, better long-term returns. TR is capped by SEBI. NAV shows per unit value of scheme, calculated daily. Entry load is 0. Exit load discourages early exit. TER directly impacts returns. Fair valuation ensures investor protection. Chapter 7 is numerical, practical, and very important for exams. In the next chapter, we'll learn about taxation of mutual funds, another scoring chapter.